Ladies and gentlemen, welcome to the Lenzing AG Strategy Announcement Conference Call and Live Webcast. I am Sergen, the Chorus Call operator. I would like to remind you that all participants will be in listen-only mode and the conference is being recorded. The presentation will be followed by a Q&A session. You can register for questions at any time by pressing star and one on your telephone. For operator assistance, please press star and 0. The conference must not be recorded for publication or broadcast. At this time, it's my pleasure to hand over to Georg Kasperkovitz, CEO. Please go ahead.
Good morning, everyone. Thank you for joining us. We are very excited to speak with you today and to share our new strategy. That is really what today is all about. For those I haven't met, I'm Georg Kasperkovitz. I took over as CEO in June, having joined the company 1 year earlier as COO. Alongside me is Matthias Breuer, our CFO. Matthias joined the company in 2023 and became CFO at the start of this year. Over the course of today, we will walk you through where the business currently stands and the direction we are taking it. Here's the agenda we have put together for today. I will start on strategy and market, and Matthias will take you through the financial section. Let me be candid about the situation. Pulp remains profitable, fiber markets remain challenging. The macroeconomic and geopolitical headwinds have proven persistent and they continue to weigh on the whole industry. In man-made cellulosic fibers, we see a structural shift, not a temporary downturn to wait out. Demand for textile fibers remains volatile. Pricing recovery is taking longer than expected. At the same time, Asian competitors have significantly improved their position on scale, on cost, and on quality. Put simply, competition has intensified and premium value capture has narrowed. Sustainability remains important, but customers are less willing to pay a premium for it. It became clear that Lenzing's previous better growth strategy was no longer fit for purpose. This is why we have initiated a strategic reset. So what does the new strategy look like? We have 3 clear priorities. Grow nonwovens, reset textiles, and capitalize on pulp. Each of these priorities has been chosen to make Lenzing more resilient and the fiber division more profitable. We are focusing on the parts of the portfolio that are less cyclical and structurally more attractive. At the same time, we are simplifying and streamlining the rest. These priorities are supported by 3 value creation levers. First, profitable growth. We are no longer chasing tons for their own sake. We will grow where we have an advantage and can earn attractive margins. That improves both the quality and the resilience of our earnings. Second, cost reduction. A leaner SG&A base has helped us in the past. Now we are going further. We are simplifying the organization, cutting SG&A costs to the core, and continue to optimize our operating costs, including energy. Third, capital efficiency. We will concentrate capital on our strongest assets. That improves returns, strengthens cash generation, and creates flexibility for future growth. The key message is simple. We recognize that the fiber market and competition has fundamentally changed. Our response is disciplined and within our control. We are growing the most resilient part of the portfolio, reducing costs and improving capital efficiency. This is how we will create sustainable value, regardless of where we are in the cycle.
Yeah, good morning, ladies and gentlemen. Also from my side, I'm Matthias Breuer here in the call. Before we go into the strategy, just let me reflect on the current trading update, pre-announcement to Q2 figures that we plan to announce on August 5th. So on the next page, a first glimpse on market situation and both on dissolving wood pulp, viscose, and also competitive fiber, cotton. Stepping back on the short term, we saw some macroeconomic and geopolitical disruptions that somehow in our segment eased the ongoing effort for accurate pricing. We also saw improving downstream demand in China with regard to textiles, which fed through also to generic viscose prices. And encouragingly, the demand for sustainable cellulosic fibers stayed resilient, which underpins stable pricing in our segment of the market. This was also supported in the first 2 quarters of the year by price hikes in competitive fibers like polyester and cotton, as we can see it here on the page, driven by higher cost of oil and fertilizers respectively. But here's the point we most want you to leave with. Although Q2 was constructive on pricing, the investment case going forward is not dependent on favorable market conditions. Our progress going forward is driven first and foremost by the execution of our strategy and does not depend on market tailwinds. This is what we want to discuss today. On preliminary Q2 performance, just starting with the top line, revenue was essentially flat at approximately 650 million euros, and we would stress that's by design. We're deliberately prioritizing value over volume. So flat revenue with rising profit is exactly the trade we want to be making. EBITDA was up 9% to euro 123 million, and the margin improved 2 points to 19%. A very reassuring development, continuing our trajectory of the first quarter in 2026. That improvement came from controllable actions. Better pricing, a richer product mix with the fiber ASP up to euro 214 per kilogram, and dissolving wood pulp ASP up to 740 euro per ton in Q2, as well as the continued cost discipline that we have proven that we can control over the last quarters. On the balance sheet, the net financial debt came down 5% to euro 1.36 billion, helped by stronger cash generation and the working capital and inventory optimization. Again, an early down payment on the lower leverage we're targeting over the midterm. A word on free cash flow. The unlevered free cash flow was lower year-on-year, but that reflects some one-off effects in the comparable quarter and deliberately a higher level of CapEx in Q2 2026 to support the strategy. The most important takeaway here on that side, the run rate benefit of everything that we are doing is not yet fully captured in these reported numbers. What you're seeing is early progress, not yet the finished picture. This brings us now to the strategy part and moving back to Georg.
Thank you. Matthias has shown you the first financial proof points. Now let us explain why we believe this is only the beginning, starting with the markets we serve. Because there's one point we want to make very clear. We operate in steadily growing markets. What you see on the slide is global fiber demand has grown by around 3% per year since the 1960s, through all crises, financial crises, and the global pandemic. Fiber demand is remarkably resilient, and our segment is even more attractive. Over the last 15 years, man-made cellulosic fibers have consistently outgrown the overall fiber market. Lyocell grew by nearly 16% per year, viscose staple fiber by around 5%. The conclusion is straightforward. We are exposed to markets with strong long-term demand fundamentals. That's a very good place to start, which is why our strategic reset is not about changing the markets we serve. It's about repositioning Lenzing to capture that growth more effectively and more profitably. This is what the rest of our strategy is designed to do, and that brings us to the next slide. The opportunity becomes even clearer when we look ahead. Man-made cellulosics are expected to grow by around 5.5% per year through 2040, significantly faster than both natural and synthetic fibers. The reason is what the industry calls the cellulose gap. Supply growth in cotton is constrained. At the same time, demand for sustainable fibers continues to increase. Cellulosics are most scalable and cost-effective way to close that gap, and that matters strategically. The fastest growing segment of the global fiber market is exactly where we compete. In other words, the market is growing in our direction. We're not betting on a recovery in the declining category. We are doubling down on a category with strong structural tailwind and decades of growth ahead. That gives us confidence that our strategy is aligned with where the market is going. Let me frame how the strategy actually comes together. We have 4 key objectives, and each is designed to achieve an outcome that matters. Sustainably higher profitability, increased competitiveness in a demanding market, strengthened resilience in an increasingly volatile geopolitical environment, and most importantly, lower earnings volatility and reduced cyclicality. Our strategy comes down to 4 actions. Shift the product portfolio, take out costs, reduce capital employed, and invest where innovation creates value. These are the 4 building blocks that will get us there. and they map directly onto the value creation levers we set out at the start. Product portfolio transition and innovation drive profitable volume growth, while the cost and capital measures deliver the cost and capital efficiency levers. We won't go through them in detail here because each one deserves its own discussion. And that's exactly what the next section does. So let me walk you through each initiative in turn. Here's the challenge we're addressing. Textile is a highly cyclical business. The cycle typically lasts 5 to 7 years with peak to trough swings of up to 40%. There's a significant amount of volatility to carry. Nonwovens, on the other hand, tell a very different story. The market has grown almost continuously and has proven far more resilient through economic and industry disruptions. That is why we are rebalancing our fiber portfolio. By 2030, we are targeting a much more balanced business mix, roughly 1/3 textile, 1/3 nonwovens, and 1/3 pulp. The path is straightforward. We reduce our exposure to generic textile volumes and adjust fiber capacity through site closures. At the same time, we continue to grow nonwovens and increase external pulp sales as capacity is freed up. The result is a fundamentally stronger Lenzing, more profitable, more resilient, and less cyclical. Textile and nonwovens require different strategies, and we are very deliberate about that. In nonwovens, we play offense. We are accelerating cellulosic adoption in hygiene, growing our tampon business, upgrading our US plant mobile into specialty nonwoven side, and harvesting value from standard wipes. Nonwoven is a fiber market where customers value reliability, quality, and verified sustainability, and where long-term partnerships create lasting value. In textile, we play for profitability. We are exiting loss-making generic volumes and harvesting value from our lyocell and viscose businesses. But we're not retreating. We are growing the niches where we truly differentiate, particularly modal and flame retardant fibers. And we continue to invest in innovation. Through Tree to Textile, we have the exclusive opportunity to commercialize the next generation of man-made cellulosic fibers, 25 years after Lenzing disrupted the industry with lyocell. So what does that mean financially?
So moving on to the performance program that will accompany also our strategic transformation, and we want to ground our cost ambitions in track records, because as Lenzing we've proven that we can implement what is in our hands. We delivered over euro 70 million of savings compared to 2022 and 2023, and more than euro 200 million compared to 2023 at the end of 2025. We have consistently done what we've said that we would. The next step is a new performance program targeting now more than euro 120 million by end of 2027, focused on a linear overhead structure and as well to a minor extent operation improvement and energy optimization. This will include the 5 million euro announced last year in September. We've already started. We've already implemented 25 million euro to be fully effective already in 2026. For the remainder, we have a clear implementation roadmap to deliver the benefits by the end of 2027. We understand the execution risk here, and in our view, this is very manageable. We know exactly what needs to be done, and as you can see, we have already started. Coming also to the footprint of implications of our new strategy. The footprint today is a legacy also of years of growth, and the honest reality is that the profitability over those sites is uneven. Our stronger assets, they have effectively been supporting less profitable ones, which adversely impacts the overall group returns. So we try and we plan to manage and strengthen the core. Lenzing is our lighthouse site, LD Cellulose in Brazil, and Paskov in the Czech Republic as pulp profit engines. Mobile in the US as very important sites in the nonwoven sector, and our remaining Asian hubs in China and Thailand. While on the same time, we simplify elsewhere. We plan to wind down sites in Heiligenstadt, Burgenland, and Grimsby, UK, and we continue to run an active divestment of the generic viscose site in Indonesia. Needless to say, this is not a decision which came very easy to us and we take lightly, but ultimately this is necessary to secure the next step of the transformation. Exiting these sites, as you also can see here, will result in non-cash impairment charges of approximately euro 150 million. And in addition, we will recognize restructuring provisions of approximately euro 40 million, primarily related to headcount reductions in Indonesia, Heiligenkreuz, Austria, UK, Grimsby, and also for the SG&A optimization program in the headquarters. These are one-time, largely non-cash items, and we see that as a natural consequence of making the right long-term decisions now in order for further returns.
So let's move on to innovation, and let me be very clear on one point. Reshaping the product portfolio and the fiber plant footprint does not mean stepping back from innovation. Quite the opposite. Innovation remains at the core of who we are. It's one of the key reasons customers choose Lenzing, and it remains a critical driver of our future growth, differentiation, and value creation. You can see that in our prioritized innovation pipeline. Lenzing nonwovens technology, that's a proprietary technology with structural cost advantages already validated by leading European FMCG customers. Free to textile, a disruptive next generation fiber platform where we have secured the controlling stake. Lyocell filament, where we already hold a leading position in a growing market. Filtration fibers address the new regulatory requirements in Europe and beyond. And next generation flame retardant fibers for the growing PPE market. So the new strategy is about sharpening our commercial focus and improving returns, not about reducing our innovation effort. We come out of this transformation leaner, more focused, and still the innovation leader in our industry. Let me bring the pieces together, because what matters is not the individual actions, it's where they take us. Our goal is clear, to build a more focused, more profitable, and more resilient integrated leader in fiber and pulp. Every element of the strategy supports that goal. We're creating a more balanced portfolio, moving towards approximately even split across textile, nonwovens, and pulp. That gives us a stronger earnings profile and reduces our exposure to any single market cycle. At the same time, we're simplifying the business. By the end of 2027, we expect to operate 6 sites instead of 9, with a structurally lower cost base and leaner capital base. And that combination matters. Lower costs and less capital tied up in the business create the financial flexibility to keep investing in innovation and future growth. In short, we become simpler, stronger, and more resilient. Ultimately, all these initiatives point to one objective: sustainably higher profitability and long-term shareholder value creation. Of course, strategy alone does not create results. It's execution. And execution starts with having the right leadership team in place. So let me turn to the team that will deliver this transformation. A strategy is only as good as its execution. So let me spend a moment on why we are confident we have the right team to deliver it. We have now a refreshed managing board in place. Myself as CEO, Matthias as CFO, and Christian Skillich as Chief Pulp and Technology Officer. Together, we combine deep industry knowledge, strong operational expertise, and a proven track record of delivering transformations. Just as importantly, we are fully aligned. We have jointly defined the strategy, agreed the targets, and taken clear accountability for delivering them. Execution is not just a priority for us, it is the priority. We are fully committed to turning this strategy into measurable results. Execution is where strategies succeed or fail. We have the team, the plan, and the accountability in place. Now let me turn to another key enabler of our value creation, our capital structure.
Yeah, thanks, Georg. And to execute a strategy like this properly, we have to start with the foundation. And the first strategic action with that regard is to lay the foundation for a sustainable and long-term capital structure. So as a first step, we intend to strengthen our equity position through a euro 300 million capital increase in the form of a discounted rights issue. 2 points I would like to emphasize with that regard. The rights issue is fully underwritten by a syndicate of international banks, and our key shareholders, BNC and Susano, have committed to voting in favor of the capital increase at the planned extraordinary general meeting, as well as participating in the rights issue. In addition, Oberbank AG, as a minority shareholder, also has committed to participate in the capital increase in relation to their current shareholding. This shareholder commitment is a strong vote of confidence in both the management team and the new strategy. In parallel, we are in highly constructive and pretty advanced discussions with our financing partners on a new debt package of around euro 300 million, including an upsizing and an extension of our existing syndicated loan and a new facility. This new financing structure perfect fits also into the implementation roadmap of our strategy. As you could see with regard to the performance program and also the exit or the consolidation of the site footprint, we plan to implement until end of 2027 and focus on a medium target window of 2028 to 2030. Taken together, the objective is straightforward and consistent with the message at the foot of the slide. These measures establish a sustainable long-term capital structure with ample headroom to support the successful execution of our strategy, while proactively addressing near-term maturities within the implementation window. For the timeline, I keep it on a rather high level. Our ambition is to complete the capital increase during the second half of this year. The key steps are the strategy announcement as of yesterday, our half-year one results, August 5th, the planned extraordinary general meeting in late August, in which we will seek the necessary capital authorizations, and then the final launch of the capital increase. Further details on exact timetable and transaction milestones will be communicated in due course. Having outlined now both on the strategic roadmap and also the financing measures that support it, let me now turn to what this also means for our financial ambitions going forward. Let me explain the logic a bit behind the guidance rather than just the numbers. First, on revenue. As expected, closing less profitable sites will temporarily lower near-term reported revenue. We would stress this is deliberate portfolio optimization, not weakening underlying demand. As the initiatives take hold, we clearly expect to return to sustainable revenue growth over the midterm. On profitability, we expect the margins to improve materially as the portfolio optimization and the value creation initiatives gain traction. The medium-term ambition is an EBITDA margin of 20 to 25%, marking a substantial uplift of euro 150 million EBITDA in the midterm, and thus bringing the leverage down below 2.5 times, down from around 3.3 times by end of 2025. And we've already taken an encouraging first step with regard to profitability. Q2 2026 margin was already 19%, up from 16% in 2025. This is exactly the self-help progress that we pointed to at the outset, and that gives us the confidence that the execution is on track. On what moves us within that EBITDA margin range, it depends on the pace of execution, how quickly we will deliver the transformation and the cost programs, supported by a stable market. Alongside sustainably improving the profitability, we have an equally clear ambition to keep strengthening the financial profile. The objective is to establish and maintain a sustainable long-term capital structure that supports disciplined investment, financial flexibility, and long-term value creation.
Thank you, Matthias. With that, we have reached the end of today's presentation, and the message we hope you take away today is simple. We're operating in the right markets, we have the right strategy, we have the right team, and we are putting the right financial foundation in place. Now it is all about execution. Thank you for your time and attention. Matthias and I look forward to your questions.
Ladies and gentlemen, we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the telephone. You will hear a tone to confirm that you have entered the queue. If you wish to remove yourself from the question queue, you may press star and two. Questioners on the phone are requested to disable the loudspeaker mode and eventually turn off the volume from the webcast while asking a question. Anyone who has a question may press star and one at this time. And we have the first question coming from Sebastian Bray from Berenberg. Please go ahead.
Hello, good morning, and thank you for taking my question. I have two, please. The first is on the reported EBITDA in the second quarter of just over 120 million. Could you please help me understand if that it contains any one-off impacts or it's an underlying EBITDA, no biological adjustments, no CO2 credit sales? The reason that I ask is that it's quite a big organic acceleration versus the underlying 80 million, and prices are in Q1, and prices are still quite strong. My second question is quite simple. What will happen to financing costs after the 300 million euro equity raise is done? By how much could these fall from the current interest run rate of about 130, 140 million a year? Thank you.
Yeah, thank you, Sebastian, and good morning to you. So I'm going to take both questions, right? So starting with the reported EBITDA for quarter two and the related one-offs, and I remember that we also had the same discussion on quarter one, where you fairly stated that there were some larger one-offs that impacted or positively impacted the results. So within the 123 million euro of reported EBITDA, we still see CO2 certificates in the amount of approximately 5 million, so significantly lower compared to quarter one, but on par what we have seen in quarter two 2025. Further, there was some positive FX development of approximately 3 million euro that also pushed the reported EBITDA, and the bioasset revaluation with a positive impact of 10 million. So walking back now to a true and fair operational performance, I would see it at the level of slightly above 100 million compared to the amounts that we discussed on quarter one. On your second question, with regards to the financing, so in principle, we do see a pretty stable profile with regards to interest rates going forward. You know, and you're well aware that there is the hybrid in 2028 that potentially is going to be refinanced. In case this is going to happen, this will have a significant step up with regards to financial results and interest rates that we're going to pay.
Thank you.
The next question comes from Saul Casadio from M&G. Please go ahead.
Hi, thanks for taking my question for the strategic update. It is very clear what you're trying. Sorry for my voice. What you're trying to achieve industrially. On the financial side, just wanted to understand that the rationale for the capital increase is it to address liquidity need? Is it to refi the hybrid? Is it to address the leverage problem? I'm just trying to understand the need for a capital increase in your plan.
So thanks for the question. I'm going to take that. So the overall package with a 300 million equity rights issue and an additional 300 million of new debt is sized to provide headroom through the execution. So it shall provide the financing for the transformation. First, this is the first aspect. Second, as I mentioned, the exit of several sites will also come with several one-off non-cash items that's going to hit into Lenzing's equity ratio. The equity rights issue will support to cure with that regard.
Sorry, just to clarify. So you have some equity rate covenant based on equity ratios, and you expect to potentially be.
No, we don't have covenants like that. We don't have covenants. It is just about operating on a, to us, sustainable equity ratio moving forward.
Okay. And in terms of cash costs for closing the assets that you mentioned, is there any significant cash costs given the fact that you're selling you're trying to sell the Indonesian assets? So overall, this restructuring in terms of footprint will be cash positive.
So what you have seen in my slides is one-off restructuring provision of 40 million. This is at the moment the provision, but will result into cash costs respectively. This is related to layoff of the headcount in Indonesia, in Grimsby and in Heiligenkreuz, as well as in the headquarter. With regards to the deconstruction of the site, we plan that there is an offset with working capital that the sites are currently, and the scrap value that the sites are currently carrying.
Okay. Thank you. Thank you very much.
The next question comes from Patrick Steiner from ODDO BHF. Please go ahead.
Good morning. Congratulations on the great efforts, which likely come with very tough decisions. I have 4 questions from my side. Firstly, how did you decide on the volume of the capital increase? I mean, do you think it's enough in combination with the cost savings to become profitable and to deleverage the still quite stretched balance sheet? That was the first one. Second one, on the 150 million EBITDA increase over the midterm. Maybe I haven't got it fully, but how do you define midterm and what is the base of the 150 million increase? I'll take these 2 and the next 2, so that's easy, I guess.
Hi, Patrick. I'm going to take those 2 questions as well. So first on the volume of the capital increase, as I mentioned on the previous question, the package is sized to provide the headroom throughout the execution, and we deem it sufficient in order to implement the strategy going forward, and it's going to support the deleveraging of the company. With regards to the 150 million EBITDA increase and your question with regards to the midterm targets, so as I said, we plan to implement throughout 2027. The go-to-market implementation with the shift in the revenue stakes is going to take slightly longer, but this should give you an idea about the target corridor that we are heading into. Other than that, I can't provide any further guidance, as you might acknowledge.
Okay, thank you very much. Third one, as you've mentioned in a question before, the exit from the sites and the restructurings, I mean, they result in the 150 million impairment and in this 40 million provision. Do you think that covers everything, or do you expect further follow-up cost of provisions you have to incur to finish your asset restructuring, basically?
Yeah. So this is, for the moment, the best assumption that we do have. With regards to the impairments, we're going to do the assessment throughout quarter 3, similar procedure as last year with the impairment on SPV. With regard to the one-off related costs, it covers the employee base, and from our assessment with the technicians that we have taken into the sites, we believe that, as I said, working capital that the sites are carrying, as well as the scrap value, are cash-wise offsetting the cost for the deconstruction that is mentioned.
Okay, very clear. Thank you very much. Last one, on Treated Textile. Can you maybe, as you've highlighted in the presentation, can you maybe explain in a bit more detail the fundamentals of the fiber in terms of pricing and quality compared to other Lenzing fibers, volume rollout, necessary capex, and aspects like this? Thank you.
Yeah, happy to take the question. So Treated Textile is a technology patented and developed roughly 10 years ago. There are other companies like H&M and IKEA involved in the joint venture. Lenzing acquired roughly 3 years ago a minority stake, and we took over the majority, the controlling stake in the joint venture at the beginning of this year. Yeah? So we have a pilot line. We produce product. The product is also unbranded, but it's already tested in the market. The features of the product are it's very, very similar to cotton, yeah, but it has high absorbency. So I think it's a very attractive product. In terms of production process and technology, we consider it as the next generation of the lyocell. So if you look at the history, in the 60s, there was viscose. Viscose requires complicated chemical treatments to get produced. Then there was lyocell, already much more sustainable. and the next generation is what we believe is tree to textile. On the CapEx side, I think it's way too early to give you any kind of estimate. We have a pilot line up and running. We will complete detailed engineering until the end of next year, and then I think we will have a better understanding of the CapEx side.
Okay, all right. Thank you very much. That's all from my side. I'll go back in line.
As a reminder, if you wish to register for a question, please press star and 1 on the telephone. We have a follow-up question coming from Saul Casadio from M&G. Please go ahead. Mr. Casadio, your line is open. You can now ask a question.
Yeah, sorry. Sorry, I was on mute. No, thanks for the follow-up. I just want to have a sense of if you can provide that the profitability of the pro forma business after excluding the pulp business after shutting down or disposing those 3 assets, just to have a sense of the EBITDA contribution of that part on an LTM basis. And if some of the mills that you shut down are EBITDA negative.
Yeah. As for understanding that at the moment we provide a company target frame with an EBITDA of 20 to 25% and an uplift of 150 million in absolute numbers, but we don't provide a target on divisional level for fiber and pulp respectively.
Okay, fair enough. Thank you.
There are no more questions at this time. I would now like to turn the conference back over to Georg Kasperkovitz for any closing remarks.
So let me repeat, first of all, thank you for taking the time and for asking your questions. We really appreciate that. I think the new strategy of Lenzing is fundamental, and I would also expect there might be further questions. Once you've studied the materials in more detail, so our investment relation teams is available, and of course we as the board are also available for your questions. So if you have any questions, please let us know. The contact details are included in the presentation. Yeah? Thank you very much for your time.
Thank you.
Ladies and gentlemen, the conference is now over and you may now disconnect your lines. Goodbye.